We have a few more transactions to discuss when we're talking about the equity section, and these transactions have to do with dividends and stock splits and various other items that we need to cover. The dividends on common stock are not legally required. I need to talk about how these dividends are handled in transactions. The board of directors is the body or the one who has the authority to declare dividends, so they will meet and they will determine whether they want to pay dividends. And in a previous voiceover I said that one of the advantages of a company issuing equity or having equity versus debt financing is that they aren't really required to issue dividends. They don't have to do it. It is whether the board of directors decides to do it or not. Of course, the common stock, if it pays dividends versus a common stock that doesn't pay dividends, the common stock that pays the dividends will tend to have a higher stock price. So if a company is going to be issuing stock, they'll get more funds in if their company does pay dividends. But most companies today really don't pay dividends. When a company does decide to declare dividends, at the point at which they declare they're going to pay the dividends is when we have to create a liability. I realize that this chapter is on equity, but there are a few transactions that are between equity and liabilities, and this is one of them. And so declaring a dividend means that you're going to have to record a liability because now you owe dividends. You owe something, a future sacrifice that you're going to have to make. To be able to declare dividends, you have to have sufficient retained earnings, and if it's a cash dividend, you have to have enough cash. And the cash part rather makes sense, doesn't it? But the retained earnings, why do you have to have retained earnings? Well, because retained earnings should always have a credit balance. So the long-term balance in retained earnings after the net income or net loss and after the dividends, it should always be a credit balance. And if you declare dividends and you do not have sufficiency of retained earnings, you could have a debit balance in retained earnings. So this is not something you can do. You have to have enough of a balance in retained earnings to cover the dividends that you're declaring. The thing about dividends that may be a little confusing is that there's a number of dates associated with it. And for the first one, the declaration date, we just said that you're going to record a liability. So you're going to do a journal entry with that date. There's usually a lag between the declaration date and the date of record. Now, what is the date of record? Well, since the stock is being traded in the marketplace and the dividends are going to go to the individuals who happen to be holding the stock, we need to say at what point we do a cutoff, or at what point do we need to stop and say, okay, who's going to get the dividend? Because if we didn't do that, then we wouldn't be sure of who we should be paying this dividend to. So we have a date of record where we basically stop and say, okay, who's owning the stock? Now, you're going to say, well, don't we have a difference in the number of shareholders? And the answer on that is no. It's just the composition of who is owning the stock changes. So if we have a number of shares that are outstanding, these outstanding, the number doesn't change. It's just the composition or who owns the shares that would change through time. As long as we're not issuing new shares, as long as we're not buying back into the treasury, in between the declaration date and the date of record, the outstanding will stay constant. And this is the case. Now, we have a date in which we're actually going to send the checks out. Obviously, this is going to require a journal entry because now we no longer owe, so our liability goes away, right? And also, when you send a check out, you're going to credit cash. And then in the year end, we're going to have to close out the dividends account to retained earnings. We talked about this briefly when we talked about closing entries right before we set up for a new year after we've prepared our financial statements. So we need to close out our retained earnings, and it also creates the basis for the stockholders' equity statement, because dividends is going to be a part of the stockholders' equity in the retained earnings. So when we declare the dividend, and again the board of directors is going to declare it, they are going to create, or we are going to create in accounting, a dividends payable or a liability account, which represents the amount which we now owe in dividends to those stockholders. It's a future sacrifice, and the past event in this case was the declaration of the dividends. The account that's going to be debited is going to be dividends, and dividends does not show up on the balance sheet. It does not show up on the income statement. It is just an account that is a temporary account that we are going to debit, and dividends will be closed into retained earnings. When we pay it, we take away our liability, and we also reduce our cash. And at the end of the year, then, what we're going to do is going to remove our dividends account, which was debited when we created the liability. And so now we're going to credit it, which completely removes the balance in that account, and it will be closed. So the balance was basically being transferred from a debit in dividends to now becoming a debit to retained earnings. This is going to be done any time in which we are closing our books and doing our closing entries. So we said before, on closing entries, you do all the income statement items. So you're going to close out your gains, your losses, your revenues, your expenses. And you also close out this other account, which is dividends. All of those accounts are closed at the end of each accounting cycle, or at the end, in this case it's year end, and they're closed into retained earnings. In addition to a cash dividend, a company could give a stock dividend. Now, a stock dividend is rather an interesting thing, because each stockholder at that point in time when they receive the dividend will have the same percentage ownership in the company. They'll just own more stock. Okay, so the percentage ownership that each individual would own is going to stay the same after this dividend. It's just that they're going to have more stock. So there's not going to be any change in stockholders' equity, and there's not going to be any change in the par value. It's just going to, in effect, put more shares of stock out there. Now, if more shares of stock are outstanding, what did we say that did to stock price? More shares outstanding will reduce stock price. And sometimes a company will just say, our stock price is just getting too high. An individual who wants to buy our stock is not going to buy it because they can't buy even a single share of stock. It's just too high priced. So if you had a stock price, and the stock price, for example, it got up to $150, an investor that had $100 to spend wouldn't be able to buy any shares of stock in your company because it's up to $150 and they can only pay $100. So you might issue stock dividends. It changes only the number of shares that are outstanding. The percentage that each individual owns, is the ownership of the company, does not change. It doesn't change the total stockholders' equity for the company, but it makes it the stock price a more reasonable price so more people could buy it. So the stock dividend then is only going to reduce the market price per share of the stock. That's all it's going to do. And when we do this dividend, though, it's going to have the same effects on the financial statements. You're going to show it as a dividend, and it will also be a reduction then in retained earnings. Now, a stock split is when we increase the number of shares outstanding, and this will change par. So when we talked about stock dividend, we said there was no change in par. With a stock split, you will have more shares outstanding and you will change par. Retained earnings, though, is not affected by a stock split. And the common terminology is a number for another number. Okay, so if a corporation had 1,000,000 shares of cent par value common stock outstanding, and they decide to do a 2-for-1 split, that means for every one share that they have outstanding, they're going to now reissue those shares and have two. So the terminology, 2-for-1, is I'm going to purchase one share and I'm going to issue two for every one share. Now also notice that stock splits are done only on outstanding. And I should have mentioned that stock dividends are also only done on outstanding. We do not give ourselves, we don't split the stock that we have in the treasury, and we don't give ourselves dividends on our stock that we're holding. Dividends and split only apply to outstanding shares. If we do this transaction, then what in effect it does is it doubles the number of shares outstanding from 1,000,000 to 2,000,000, and it reduces the par. So before our par was a penny, now our par is half a penny. And if we have more shares outstanding, what typically will happen here is that the market price should be half of what it was before the stock split. So if our company had stock that was trading at $100 a share, after a stock split, it will probably be at $50 a share. So a stock split also will have the same effect as what we were talking about on a stock dividend. It will create more outstanding shares and reduce stock price, which, if an individual is unable to buy at the current stock price, then they may be able to buy the shares now at this reduced stock price. What happens in our financial statement when we're looking at the actual dollars, and you get into the dollars down here, is that the dollar value of stockholders' equity does not change as a result of this transaction. Only our captioning changes. So when we look at our balance sheet, instead of showing 1,000,000 shares outstanding, we're going to show 2,000,000. And when we talk about par, we're going to list par in the captioning not as a penny, but as a half a penny or a half a cent. Preferred stock. Now, preferred stock is preferred means it has some priorities over common stock. I think I said previously that preferred stock usually does not have any voting rights. But what happens with preferred stock is if a company decides to issue preferred stock, I have to tell you that most companies do not issue preferred stock. If a company issues preferred stock, it is kind of treated a little bit like debt. And I will explain that to you. It is not that we have to repay what the stockholders pay for their preferred stock. No, we are not going to have to repay it. It is like common, it's contributed. But instead of paying interest like we pay on debt, we often pay a dividend to preferred stockholders that goes along with their buying of the stock. So when a stockholder buys preferred stock, often we say that it has a fixed dividend rate. Compare this to interest that is paid on debt. It's something like that. Except it's a little different because if no dividends are declared, then we don't have to pay it. On debt, we will always have to pay that interest. On preferred stock, we can get out of paying this dividend, which is something like interest. We can get out of paying it by not declaring dividends. Alright, so preferred stock is kind of an odd thing. It behaves a little bit like debt because instead of interest we can pay dividends, and we may be required to pay dividends, but we can get out of paying the dividends. Unlike interest, we can get out of paying these dividends by not declaring any dividends for our company. And it's not like common stock because there's no voting rights. So it's a little of an odd thing, and a lot of companies don't even mess with it now. They have common stock or they have bonds, and they don't even have preferred stock as a financing option. When we issue our preferred stock, we are going to issue the preferred stock, and we are going to use the same concept of par and market when we do it. So we are going to have preferred stock, which is par, which is here $1, times the 400,000. Just like common stock, this par designation is very arbitrary. It's set up when the company is established, and it really has no meaning other than going into this journal entry when we issue our stock. And so par times the number of shares becomes preferred stock amount, and the amount of the market price minus par times the number of shares becomes this valuation. In this calculation, they didn't give us our market price up here, so I can't relate it back and show you those calculations. This cash amount will be always the market price times the number of shares, which they tell us that value is this amount. So they're backing into numbers. If the par is 1 times 400 or 400 here, and our debit to cash is going to be this amount, then our additional paid-in capital must be the difference between this, and that's how they came up with the numbers. Now, preferred stock dividends. We said they usually had a rate at which they were paid. A cumulative dividend means that if we don't pay dividends because the stockholders don't declare dividends in a particular period of time, then these dividends will be paid when we do declare dividends. And the other thing about it is the preference is that these preferred stock, they get their dividends before any dividends go to common stock. So one of the advantages of preferred stock then is that it tends to pay dividends, and as long as it is declared by the board of directors, you will probably be paid those dividends. Although you may have an arrearage, you may not be paid all you are owed. As long as the dividends are being declared, you should get paid eventually. Okay, and I'll give you an example of that. However, one of the disadvantages is with these dividends, you have to wait until they're declared, and you may have to wait until all that you're owed is paid. You're also not going to be paid any interest on it. So that's a kind of a disadvantage. If we say non-cumulative, they don't they are permanently lost any dividends. And so what I'm going to focus here, though, is on cumulative. Cumulative means any unpaid dividends from previous years, we call that dividends and arrearage, must be paid before the common dividends are paid. We need to get into an example here because all that discussion I know was quite confusing. Here we have Flavoria, a company declaring dividends totaling $8,000 in 2015 and $10,000 in 2016. How much of these dividends would go to each one of the stockholders, the preferred and common stockholders? Well, the dividends on the preferred stockholders, if you see the caption, and the caption is 6%, what we need to do is we need to multiply the 6% times the par times the number of shares to get the amount of dividends which should go to the preferred stockholders. So it's 2,000 times 20 times 6% of that, or 0.06. This dollar sign is an error. It's 0.06. is $2,400. The dividends going to preferred stockholders should be $2,400. If the board of directors declares dividends, this is only if they declare dividends, and they declared $8,000, then the preferred stockholders would be paid their $2,400, and any remaining dividends go to common. So the preferred stockholders will get theirs first. Now in the next year, it's $10,000 that the board declares. Well, $2,400 will go to the preferred stockholders, and the common will get the remainder. So you can see why I'm saying this is a little bit like debt from the corporation standpoint, because no, they are not paying back ever for the amount that they received from the investors by selling the preferred stock. They are paying a dividend which looks a lot like an interest payment, doesn't it? Okay? It looks a lot like an interest payment. And in this case, it's 6% times par times number of shares. With interest, I think what we did was we looked at the dollar value of the amount and we multiplied it by a percentage, and this was an annual percentage rate, and that was our interest expense. It's not interest expense here. Instead, it's dividends that are being paid to these investors in preferred stock. And when they bought the stock, they knew that it was 6%. They knew what the par was. And obviously they determine how many shares they're going to buy. So they have an idea when they buy the stock what the dividends are going to be. However, they are existing at the privilege of the board of directors. In other words, if the board of directors does not declare any dividends, they're not going to get the $2,400. They will get zero in 2015. If the board of directors does not declare dividends in 2016, how much will they get? They will get zero. So it's not quite the same as interest expensed from the company standpoint, because they can get out of it by simply not declaring the dividends. Now, dividends in arrearage means that they haven't paid dividends or declared dividends in the past. And if it is a cumulative preferred stock, then that means the company can't completely get out of paying it. So in this case, in 2015, if there were an amount owed for 2 years to the preferred stockholders, for the past 2 years they did not declare dividends, and these preferred stockholders should have been paid $2,400 each year, or $4,800. In 2015, when we do declare dividends, we have to pay what we owe to the preferred stockholders first. So we'll pay them their arrearage for the past 2 years when we didn't declare dividends, and we will pay them this year's dividend of $2,400. And when we pay those two, that adds up to $7,200. We only have $800 left to pay the common stockholders. In the next year, we've paid off all our arrearage. We are just going to be paying the preferred stockholders $2,400 because we can pay all of it. Our dividends declared exceed the $2,400, and the common will get the $7,600. So if you have something called cumulative preferred stock, then you will be paid as long as eventually the dividends are declared, and you will be paid for your arrearage. But notice they're not paid any more. They're not paid any interest for having to wait the 2 years, or at least 1 year here, 1 to 2 years to get this. They're not paid any interest. They're only paid the $2,400 plus $2,400. No interest on it. So yeah, it's not quite as good, I don't think, for an investor as, say, buying a bond. Retained earnings, as we said other times, reflects the amount of earnings minus dividends. Sometimes a company will have a loss, And if a company has a sufficient loss that it consumes all their balance in retained earnings, then we have a deficit in retained earnings. And in this case, we incur a loss of $130,000 in 2014, and as a result of that, our balance sheet in 2014, our retained earnings was negative, or a debit balance. Well, if you have a debit balance in retained earnings, then you could not declare dividends. Okay? So, as long as they had this debit balance in 2014, they would not be able to declare dividends. In 2015, when this balance becomes positive, then they could start declaring dividends. The other thing that the reason they can't declare dividends, if it's a cash dividends, it can't be declared if there's no cash. So if you have no cash, you're not going to be able to declare the dividends. The statement of stockholders' equity we talked about earlier, and we said it was one of the 4 required statements. And I said, for now, I just want you to understand the retained earnings statement, which is beginning balance plus net income minus any dividends. And here they have the dividends to preferred, and they have dividends to common. And that gives us our ending balance. It's positive, which is a good thing. We really don't like to see the negative balance in retained earnings. And this is where we left it. We just said, well, we'll do this, statement of retained earnings. Under GAAP, if there are any changes in any of the stockholders' equity accounts, we have to do this walk forward sort of a statement. In other words, we have to show the beginning balance, we have to show the changes, and we have to show the ending balances. This is a requirement. So with this company, you can look at it and you can say, well, what statements would they have to do? Well, with preferred stock, it changed because they issued. So they would have to show this. They would have to show this description of what happened to the preferred stock. With common stock, we issued common stock, so we would have to show that one. And additional paid-in capital is changing as well. So is retained earnings. And so, yes, almost every situation you're going to have to pay, you're going to show retained earnings because there's going to be net income. Treasury stock, though, look, there's no transactions. Because there's no transactions within this, it wouldn't be a required statement. Accumulated other comprehensive income, we have an adjustment here for aluminum contracts. You don't need to understand any of this, but there's an adjustment to it, and since there's an adjustment to one of these parts of stockholders' equity, we are going to have to show it. So the only one in this group that we would not have to show and the statement of stockholders' equity would be treasury stock. Since there have been so many changes to so many of these stockholders' equity caption accounts, they combine it, and they put it into one statement which shows all these changes. This is perfectly appropriate for GAAP, and this is often done by corporations. Very common to see it like this.